Hello and welcome to FXCM's presentation on hedging. What is hedging? Hedging is being long and short the same currency pair at the same time. If you're unfamiliar with the terms long and short, here's a quick summary. When you buy a currency pair, the position is considered long, and you'll have a profit if the price rises, or a loss if the price falls. When you sell, your position is called short, and the opposite happens. You can easily hedge on your trading station simply by buying a currency pair and then selling it. Both trades will appear as separate tickets in your open positions window, like this. When hedging, you don't need to pick a direction for the currency pair, since one of the trades will generate a profit, no matter which direction the price goes, up or down. If the price goes up, the long position is profitable. If the price goes down, the short position is profitable. The thing is, when this happens, the other side also generates a loss. For example, while the long position generates a profit when the price rises, the short position generates a loss. This makes the hedging strategy a bit counterintuitive because your losses erase your gains. Hedging does become very useful, however, in low volatility, range-bound markets, where the price spends a lot of time moving sideways as opposed to in a trend up or down. With hedging, you can make maximum use of trading in this environment at any time. Let's take a look at the often range-bound Euro to Swiss franc pair. Here you can see that the price fluctuates between support, here at the bottom, and resistance at the top. To effectively range trade, you want to buy at the bottom support and sell at the top resistance, harvesting pips, and therefore profits, going both up and down. The big problem I have with range-bound trading is that when I usually sit down at my computer, the price is not at its support or resistance, but somewhere in the middle instead, such as right here. So, I'm not really in a great place to buy or sell at the moment. With hedging, that's not a problem. I can get into the market any time and take advantage of this range. I simply go both long and short right now. I then set my limit orders to close my trades and book my profits at the edges of the range. Say after I enter the market, the Euro Swiss rises to the top, here at 165.95. The limit order triggers, closes my long trade, and the profit is added to my balance. Meanwhile, I continue to sit on the losing side of the short trade. Now, as you can see, in the recent past, the Euro Swiss has risen and fallen gradually between these support and resistance levels. If I think this will continue, I can hold the short trade until it falls to support down here. There, the limit on the short trade will hit, and I can book my profit. As the currency falls, also look for a good place to buy in again, reopening the long side of the hedge so I can continue to capture the range as the currency fluctuates back and forth. Now let's take a look at how I would enter it in my trading station. I simply buy and sell the Euro-Swiss pair. Here's my long trade, and sell for my short trade. I then set my limits at the edges of the range. For example, here on the short trade at 165.35. Now, ranges don't last forever, so I want to protect myself if the currency breaks out of this range. So I'll also set stop loss orders in each position at the next level of support and resistance. So if the currency starts to move strongly in one direction, I will no longer be on the wrong side of the trade. Our research site, dailyfx.com, has a very useful article to help you with your hedging. Come down here to the trading section and look for hedging range trades. This article will rank different currency pairs by their risk level for hedging, as well as suggest to you the support and resistance levels to set your limit orders, as well as suggested stop orders. These are all based, of course, on support and resistance. This is published every Wednesday, and you can find it at dailyfx.com.